have Adrian Mowat, who is joining in, EM Equity Strategist, to discuss this and a lot more. Thank you so much, Adrian, for taking time out. As we alluded to at the get-go, this is, of course, the big headline. The fact that America will not default, being categorically said by Joe Biden, perhaps in the 11th hour, but nonetheless, it is going to come in as a relief.
Yes, it does. I would slightly caution you on saying that this is all about the debt ceiling negotiation. There was an announcement by Western Alliance Bank that their deposits had grown, and we saw a significant rally in financials in the US overnight. So if you look at the main financial ETFs, they were up between 2 and 3%. So I think that was probably the bigger contributor to market performance than the president saying that they'll come to a deal. Because remember, we're talking about coming to a deal. We don't have a deal yet. So I would suggest that the risk-on rally had more to do with financials than the debt deal.
So Adrian, now that things are falling, or things are aligning beautifully, US debt ceiling, perhaps the political stalemate will be over. US regional banks, they've been rescued and they've started rallying back. Crude and commodity prices are lower and inflation is down. So are we in for a charged up risk-on environment for global equity investors?
So I think that, you highlight that there are some good fundamentals out there. So if we can reduce the stress within financials, both in Europe and in the United States, then I think you could get a broadening of the move that we've seen in the US market and the European market. So it's been European cyclicals that have moved, and in US you've had some of the major stocks such as Meta, Google, Amazon, Nvidia, etc., that have been driving the market. I think if we can see the market in the US broadening so that the financials are starting to add positive attribution as opposed to being significant declines year to date, then that would be good for maintaining the broad rally that we're seeing in developed markets year to date.
Amidst all of this, Adrian, just wanted to understand what's in it for India, because, India, in that sense, the central bank has been ahead of the curve. It was a pause this time around. Inflation seems under control. And FII participation as well has come back to India equities. More so that entire case of money now moving into China and flowing out of India, that doesn't seem to be holding true.
Well, I think that the delta that's occurred within the major emerging markets is confidence on China has diminished since the market peaked late January, early February. We've actually had a very good economic data. I look at the Citibank Economic Surprise Index for China. That is very high, but it's interesting that the qualitative narrative rather than the quantitative data has been much more circumspect about China. We just had results out for a big Chinese IT company, Tencent. The numbers at an operating level were strong, but they did have a bigger tax bill, and the stock has fallen on the back of that. So I think the confidence around China is more fragile, and at the margin, India is benefiting from that. Now, the Indian macroeconomic data has continued to be robust. And if you look at sector performance year to date, you've had good performance out of selected financials and very good performance out of the auto and the two-wheeler sector, which are classic proxies for a strong consumer in India. And the market is only up 1% year to date because you've had weakness in Infosys, which partly reflects a corporate in the United States cutting back on costs. And plus, you've had weakness in the Adani group for well-documented reasons. And finally, we've had weakness in stock like Hindalco, and we've broadly seen weakness in commodity companies across the globe, not just in emerging markets. So, if you've been in the right sectors in India, a bit like being in the right sectors in the United States, so far it's been a pretty decent year.
Mowat, always a pleasure, and thank you for joining us. So let's